Welcome back to Investment 360. Now, the 361 Met Flexible Opportunity Fund is a domestic flexible asset allocation unit trust that we've spoken about already. And the fund, as JP was saying, invests predominantly in the South African equities, but can also hold other financial instruments, including bonds and cash. You've spoken about the flexibility. You've said that it can go. If you wanted to, you could reduce your equity exposure fully and move into bonds and cash, but you're not going to do that. You like the equity exposure. So let's now talk about your top holdings in the flexible fund and how it's changed over the last 18 months. So I take you back now to 6 months, 12 months, and Naspers is at the top in terms of your top holding. You're not changing your standpoint on Naspers?
Well, we haven't changed it over the last year or so. And look, we call ourselves value investors, and a lot of time investors look at our funds and say,
your growth, your momentum.
Exactly.
That's the first thing I was looking at here.
Naspers, no one would see that as a value stock. But we are less dogmatic than some other value investors, where we don't just see value as being a low price to book or a low PE stock, but a stock that's worth a lot more than our valuation is a lot more than the current share price. So Naspers is one of those stocks where when we look at Tencent, which is the majority of the valuation of Naspers, we see a company with high barriers to entry in China for political and social reasons. We see a company that is dominant in the niches that it operates. It's like Facebook and WhatsApp and LinkedIn and all these companies combined.
Are you not worried about the blue sky that could potentially be built into the Tencent story?
Well, we think that some of this blue sky is actually coming to fruition. For instance, if you think about the cell phone, which has become such a complex device, it can do increased functionality, better graphics. They can now take the games, which was a big money spinner for them on the PC, and have a very similar game on your handset, on your mobile device, and start monetizing that. So we think actually that mobile monetization is a big growth vector for them. So we're not concerned about that valuation yet, even though the share has done exceedingly well, but the qualitative aspects make that we are sticking with Naspers.
How do other value managers out there react to your philosophy when you call yourself value managers? Because your stance here with some of your stocks is tantamount to blasphemy for value managers.
Exactly, and that's why we say we are not dogmatic. So this is not a religion.
They're going to come back and say, style drifter.
Correct. We don't like being placed in a box. So don't put us in a box. If you call us value, we are pragmatic value. We are good business people, we would think, and we look at companies as businesses, and whether you want to call it growth, you want to call it value.
And it actually fits with Investment Solutions, the conversation that we had with them recently, where they said there's value and there's non-value.
Exactly.
You would fall into the non-value camp, although you've got value elements in some of your plays.
I wouldn't even put a label on it. Like I said, we're not dogmatic and we're flexible in our approach. If you go back to Buffett, for instance, the way that Buffett started when he was a disciple of Ben Graham versus when he met Charlie Munger and after that is very different. And even today, if you look at the mega deals on preferred terms that he can do, very different. So you need to be flexible in your approach and never dogmatic would be what we would say.
Now you are holding Foschini as one of your top holdings. This is a new play. I don't see it represented previously.
Correct. So because we think that the SA consumer is still in a tight spot, but maybe we are through the worst. And also thinking about, if I'm a consumer under pressure, which loans would I pay first? If I think about my relationship with a bank that just gave me an unsecured loan and I don't have a bank account at that bank, versus a company that gave me some credit, I bought my clothes on credit, I want to feel good, I want to have that new jacket for the next season or look good when I go to work, I'll probably first pay my apparel retail account before I'll pay my unsecured loan. And because of that and the valuation that we think is quite attractive after a retracement in the share price of Foschini, we very recently started acquiring Foschini shares.
Old Mutual still features, and it was there 12 months ago, 6 months ago, and it's still in the holding. How much more upside can there possibly be to Old Mutual? It's run hard.
It has run hard, but there's been good reasons for it to run hard. We started accumulating Old Mutual as a big position when they sold the Scandi operation. That was a big value unlock for them. We think most recently that they've de-risked Bermuda. It's a non-issue now. On a price to embedded value basis, it's still at a discount to the other life insurers locally. Their Mass Foundation cluster showed very strong growth, once again speaking to the lower end, maybe not being in such a bad position. So yes, the discount to intrinsic value has narrowed, but we still see some upside in Old Mutual.
Adcock Ingram, I'm picking out all the stories that I see here, and this is interesting. This is a new addition to your portfolio. You haven't had it previously. You are cashing in on potential corporate action. You think this one is going to burn up, so to speak?
Correct. We were even short Adcock not too long ago, probably a year or so, when we did think that management could have done better. But because of the deal and the metrics and the purchase price that CFR is offering or will offer when it is a firm offer on the table, we think it's a good arbitrage opportunity or special situation. CFR released quarterly results today, which were up more than 50%. So I think some of those investors that had some concern about the high PE rating of the scrip that might be offered as partial compensation will be answered by the very good results of CFR. So if this deal goes ahead on an annualized basis, the difference between our purchase price and the takeout price in the mid-70s make for a quite decent annualized
Could we
return.
see a further bidding war? Are you betting on a bidding war when it comes to Adcock?
I don't think Bidvest will come back. Maybe another multinational could look at Adcock, but there is a exclusivity period now with CFR. So even without a bidding war, we see decent upside. If there is a bidding war, that just puts some cream on top.
All the better for you. Another stock that we will be talking about in hot stocks later is Netcare, and it looks as though that's going to turn out favorably in our discussion when we compare it to the likes of Alive Healthcare, Discovery and the other players, Mediclinic out there. Why Netcare, besides the fact that, and we will mention it later, that Richard Friedland is a vet and a doctor, you know that.
Very
is that
impressive.
why you're backing it? It's very impressive.
Well, we need a bit more than that. So notwithstanding that very positive element of Netcare, we started buying when everyone was so negative about GSG. They saw the writing on the wall when you look at UK property prices that maybe PropCo would go insolvent because of the very high loan-to-value ratios. And when you dig into the detail, we saw 2 years ago already that these businesses are ring-fenced. And even within GHG, the PropCo is ring-fenced from the OpCo, which is where the real value is. So when other investors were fleeing, we were going in because we did our homework. And we are still holding that position. We saw in the last week GHG announcing that they are in discussions with their banks to sell some of their properties in the next 3 years. That should be a good outcome, even if that means that there's zero value then in the PropCo. And yes, if you compare the Netcare local hospital operations to the other local players, it is at a significant discount.
Anglo American you've been holding for some time. So 6 months ago you had it in the portfolio. You are still holding on to this one. You didn't have it 12 months ago.
Yes, so other value investors were buying Anglo American a year ago, were buying Platinum a year ago. As business people, we tell ourselves we still want to see the light at the end of the tunnel. It was quite dark a year ago. With Marco Tifani now at the helm, with rationalization in global supply of commodities, with China coming out with better macro data, we're a little bit more optimistic about the miners, and especially Anglo-American based on valuation metrics. And that's why, even though the weighting has been steady, the share price have gone down, which implies that we have been buying more all over the last 6 months or so.
JP, it's time for a moment of the truth, and this is when I ask you your best investment decision ever.
Joining 361.
All right, I'll take that. And your worst investment decision ever?
Well, I would say in 2008, being geared long. Watch out for margin calls, they hurt.
That was Jean-Pierre Verster from 361 Asset Management. You can contact him on @JP_Verster, and that's it for Investment 360 this evening. You can follow me on @Bronwyn Nielsen. After the break, stay tuned for Hot Stocks, where we'll be discussing the private healthcare sector with Gebran Smit from NEFG Fund Managers and our resident expert, Paul Turon from Vestact. Stay with us.